Let's talk to a very hot Mike Ingram. He's Chief Market Strategist of WH Ireland, and he's only hot because he's been on public transport. Morning to you, young Mike.
That's about the only way I can be hot, Moose.
Boom, boom.
Thank you.
At our age as well.
Well, indeed.
Right, headline, are
Yes.
the markets changing gear?
Yes. Yes. I mean, 2017 was a classic, what I would say, melt-up situation. Virtually no risk being priced into the market. You were seeing this in things like the VIX, but along a much broader range of risk indicators. It was a very risk-seeking market. You saw this in performance of emerging markets, for instance. They put on between 25 and 30%, depending on which index you're looking at. And I think that February, March was a bit of a wake-up call for many. You had plenty of what I would call momentum monkeys in there who got badly shaken out, and I could scarcely contain my laughter seeing some of these headless chickens roaming around. But I mean, at that time, as I think I said on this show, it wasn't an inflation shock, it was more of a risk shock. It was transmitted via a lot of these sort of short vol, long duration products, particularly in the equity market. And a lot of these are just been vaporized since then. Inflation hasn't really been much of an issue this year, despite the fact that growth, generally speaking, has come out better. Now, I'm going to caveat that. If you looked at the forecast at the start of this year for GDP growth in all sorts of reasons, we are, generally speaking, we're higher now than we were then. We are not as high as we were maybe 2 months ago. So you've seen upgrades in the US, you've seen emerging markets broadly flat, you've seen forecasts pared back in Japan and to some extent the Eurozone. So, and on the earnings front, actually, you'd have to say that, generally speaking, we're either there or better. The UK in particular, and obviously you've got this big external sector, a lot of miners, a lot of oil companies, and we've had a bit of weakness in sterling and a bit of dollar strength as well over the last couple of months. So, again, if you look at the earnings forecast to say, the FTSE, it's up 5 to 6% on where it was at the start of the year. So growth, okay, momentum, not great, but the growth okay, earnings okay. What has changed, and the reason why some of these indices are struggling, is the risk environment's being repriced, and we're seeing this at a number of levels, particularly in the credit space. Something I've been looking at, particularly over the last couple of months, has been how the performance of emerging markets. Because then I can look at the boxes to tick, and I can say growth is fine, earnings fine. But if you look at the credit environment of emerging markets, they've really been struggling, and that's something. They rode February, March out quite well, which is why one of the reasons I say February, March was not a risk-off incident as such. It wasn't an inflation incident as such. But even though dollar liquidity has eased over the last 2-3 months, even though the market seems broadly comfortable where the Fed's going, not quite pricing 4 dots by the way this year, but reasonably comfortable what they're thinking about. But the credit into emerging markets has continued to be squeezed, and again, if you plot the sort of the tightness of hard currency credit spreads against the relative performance of emerging versus developed, that's a pretty decent correlation that you see there. So that's these are all the sorts of things that we have to grapple with when looking at investing, on a global basis on the behalf of clients. And as I've said, the goalposts keep on shifting, so you keep having to analyse and reanalyse and test your assumptions in order to make sensible decisions going forward.
Okay, so let's talk a few words about sectors. Any sectors that you particularly like, or more importantly, particularly dislike? Well,
I mean, I think one of the things which hasn't panned out this year, and I think you may remember I was quite sceptical at the time, one of the big consensus calls at the start of this year was reading my mind. So there was going, so of course the theory being yield curve steeples, yield curve steepens. You're borrowing short, you're lending long, you make a better profit margin. That has largely failed to happen. If you're one of the more poor sectors, have been banks. There's been a bit of a mismatch between the US and elsewhere, but obviously there's a micro story, there's a deregulatory story there, and I would say on a structural basis the US banking sector is much healthier than it is in Europe and to some extent the UK. But I mean, again, you've seen, Deutsche has lost their CEO since I last spoke to you, I think. So I won a bet, I think, on the back of that. I don't know if you think that's unprofessional, but I'm not telling you who I was. One of 2 CEOs I said was probably going to go within 12 months. One of them's still in place, so we'll see. I'm not going to tell you who that one is, but you might guess. Yeah, it's been very poor earnings. I mean, if you look at, again, the earnings estimates for, say, European banking sector, they've been pared back by something like 6% since the start of this year. So that's one thing which hasn't panned out. And again, one of the major surprises, which is why, if there is an inflation story, it's an imported inflation story, it's a headline inflation story, it's not a core inflation story, has been oil. And obviously we've had no small amount of drama from OPEC over the last few days. But I would say thematically, if you believe that we're relatively late cycle, and I think you'd have to say that in the US, certainly, Europe is some way behind that, that thematically you should be in sort of inflationary type assets, and that's energy, that's metals and mining, etc. Of course, bottom up, you're still going to buy something, and sometimes the bottom up story doesn't actually chime with what you're thematically talking about. But when if you're talking about these sort of so-called investor clocks and what sectors perform well at certain stages in the cycle, those are the sorts of things that historically you would be looking at.
And finally, Bank of England.
Aren't they useless?
We've got to talk to Ms. Carney just for 30 seconds. Any chance of a rate hike in August?
Oh, there's a chance. I mean, the market's gone from thinking, prior to last Thursday's meeting, 45% chance. I looked at it this morning. I think it's 76% chance on the overnight index swap. I mean, look, if it all pivots on how the whole Brexit thing goes. As I've always said, it's either going to be hard Brexit or no Brexit, and frankly, it's a coin flip as to which way it's going. Ultimately, it's a political decision, and depending on which way that goes, the Bank of England is going to have to, I think, stay on votes. I think it was incredibly unwise for them to sound so certain. This is what I couldn't figure out, and I think this is the last time I spoke to you. Going up to the May meeting, thinking, well, the market's thinking. At one point, it actually hit 100% chance of a May rate hike. And I'm thinking, how can they be so nailed on when there are so many imponderables, identifiable imponderables, negotiations over the summer? And since then, I'd have to say, it seems to me, personal call, that things have got cloudier.
Yep.
Yeah.
On that note, young Michael, great to see you. See you in 2 weeks' time. That's Mike Ingram from WH Ireland. Thank you.